Hey everybody, I'm Joe Killinger. I'm a real estate investor and entrepreneur, and we put these videos together every week to give you all the tips and insights from my experience over the last several years. So make sure you tune in and subscribe, and thank you.
All right, new week, new video. This is going to be a good one. I've got a couple of special guests here. One, you've seen his mug a lot. We got a new one here, though. Investing in real estate versus investing in stocks. You're going to love this one, so make sure you subscribe. And don't be afraid to smash that like button at the end, please. All right, so my guest today, I've got Kerry. Say your last name?
Botensten.
Botensten.
Lots of syllables in there.
Yeah, that's my thick tongue. It doesn't work very well. Kerry, why don't you give a little bit of your background?
So my background, I grew up in New York. I worked on Wall Street in wealth management. We were doing investing for high net worth individuals. I had a little bit of a turning point, decided to travel for a little bit, and I got into traveling and decided that I wanted to go with my passion and make a business out of it. So I started doing some consulting, some marketing, and then this year with the travel industry down, I've gone back into the stock markets for a little bit for the time being.
She has a very interesting travel company that we're going to get to at the end of the video. We'll close it up and talk about it, and then we'll give everybody, there'll be a link at the bottom. And I think many of you remember George. George is the CEO of Commercial Brokers International in Los Angeles. George, thank you for coming in today.
Thanks for having me again.
So, real estate or stock market? Who wants to go first? We've got, the gloves are on.
Well, all right.
If I'm a first-time investor, I'm fairly new, where should I be putting my money right now?
Well, I think the first thing is to talk about the differences for 2020 on why you'd be investing in corporate real estate or the stock market.
Okay.
I think the first thing is money. The more money you have, probably more potential of going to real estate.
Right.
The second is longevity. So usually if you're going into real estate, whether it's residential or corporate, you're thinking 5 years plus. Stock market, you could do daily, you could do minute, you can do however long or short that you want. And then I think the third thing is, in real estate, it's more tangible, or it is tangible.
Yes.
So with that in mind, I think it depends on your preferences as to, based on those three factors.
I completely agree with Kerry here in that, really there's certain different variables that we have to take a look at and really address. The biggest barrier to entry for real estate is the down payment, the capital requirements. You can easily get into different types of REITs, of course, if you wanted to, in the stock market, if you still wanted to be involved in real estate. I do believe that for the most part, people should have a diversified portfolio. At the same time, I think personally, I think the stock market's a little bit more risky, but that may be just because I'm so focused on real estate and I understand it, I live, breathe, and sleep it, so that could very well be it as well. And I'm sure Kerry has the exact opposite feeling.
Yeah. I was going to say, if we were to look back to March of 2020, and it's very comparable to 9/11, it's very comparable to 2008. And what you saw there was a lot of fear, and you saw people thinking risk. But the people that succeeded and at that moment were the people that took that fear out and took that risk out because they knew it was going to come back. It was a cycle. So in my eyes, everybody that I talked to in March, I said, if you don't invest right now, you're going to regret it. It's the same as those people that didn't invest in 2008. And I thought investing at the beginning of this year was probably the least risky thing you could do if you were investing in conservative, innovative stocks or companies that would continue past the pandemic.
We've got a good number of agents, and a lot of them are trading on a few different platforms. And I don't know how well they're doing, but what do you think about somebody that is not doing it every day, trading on these platforms?
Platforms as in like Robinhood.
Robinhood, yeah, that's most of the ones that they're using.
Well, you know, it depends. I think this year was a good time to get in,
Right.
to learn.
To really learn the basics?
The problem is, this is not a normal year to be investing, so you also have to be cautious. Like, this year was comparable to real estate where it's long-term.
Right.
So if you were investing at the beginning of this year, you should be investing long-term, and you shouldn't be
Yeah.
day trading.
Right.
So it depends on how they're investing. I do think it was a great year for beginners. I really, really.
Oh, yeah.
And
Yeah.
so if they're on whatever platforms these are, and they're investing and they're diversifying, so you want to have a little bit of healthcare, financials, consumer staples, et cetera, then I think it's great. It's easy to use, the fees are low.
Mhm.
The problem is, you have to make sure that that money that they're investing on these platforms are not money that they need in the
Right.
short term. And so my personal rule of thumb, and this is extreme, but I say it to everybody, I say any amount of money you put in the stock market, you have to assume you don't have.
Yeah.
Chances
Or
of
if you
that are-
make a little, pull what you've started with out,
Right.
and then the residual, make the push after that. Where do you see, why do you think it's going to be harder over the next, going forward?
Because it's not going to be about obvious stock picks. It's gonna be about fundamentals.
It's going to go back to,
Yeah. Like, for me, when I was teaching first-time investors, beginning of 2021, I was like, know which companies are already set up for this. Companies that are already set up, you have, you know, the obvious was Zoom. But you
Yeah.
also have companies like Dunkin' Donuts.
Mhm.
They already have a drive-through. They already have contactless. You already have Amazon. They're already delivering to your door without seeing you.
Right.
Like, you have those obvious factors that are gonna go through. But what's gonna happen is, once people are vaccinated.
And they all need real estate.
Well, so yes, they do, exactly. As they grow.
So, no, it's funny you say that, because I say the same thing to a lot of our first-time investors as well when it comes to the real estate side. It is really boils down to the real estate fundamentals, and then when you look at it and, you know, as you invest, you're very much co-aligned with a lot of the tenants, especially if you're investing in investment-grade
Yeah.
properties that are, you know, like single-tenant, net lease, corporate guaranteed type products, which tend to be a little bit less risky, a little bit more of a cash flow play. They're considered a little bit more liquid as well, because there's always a secondary market. And, you know, as long as you bear down on the real estate fundamentals, you know, we've seen properties throughout this, especially that asset class, go up in price and cap rate compression, where investments have been made either by just purchasing and holding within the year, which is very short term for real estate, or
Is that
just
destination
repositioning.
based? I can't imagine that was in all cities.
No, you know what, it's not so much destination based. I would say it's not necessarily all cities, but here's what whenever I talk to my clients, I tell them that I can almost always, maybe not in Wallback, Nebraska, but
Definitely not.
almost always find a strong real estate property that has really good real estate fundamentals, whether it's a tertiary market or whether it's a major metro, because, you know, even these smaller towns, they can support quite a bit of stuff. But so you look at the basic things, whether it's you know, you bear down on the real estate. Is it a hard corner signalized intersection? Who's the tenant? What's the demographics? What kind of traffic counts are you
Yeah.
getting? You have to do your research, just like I'm sure you would do your research on any stocks.
Right.
And then,
Yeah.
is it right next to the local high school, which may draw from multiple cities? So if you have a fast food location next to a high school, right across the street from it, even though it's a small town, it may have a larger high
Convenience.
school, and it's there, that's who goes. So, you know, you can almost always find a good real estate opportunity in different markets. And then the prices vary, you know, it's risk versus reward, just like anything else. Wonderful thing I like about real estate is that it is not as volatile. You're not really betting on people as much as companies. I mean, the real estate market, rather the stock market for me, from what I have seen, and most of my stock investments are very stable, very slow growth, is that it tends to have knee-jerk reactions. And a lot of people, the herd mentality is when they see it go down, they start freaking out. But, Kerry's absolutely right in that you double down. This is when you double down. And you look at where you can go, and look at it, if you approach it more as a long-term hold versus a short-term hold, then it can work. But the same goes for real estate as well. In that, the Hearst family, who owned quite a bit of real estate after their media holdings, they were once asked, how do you time you've done extremely well in real estate, in fact, made more money in real estate than they did in their media holdings. How did they do so well in the real estate market? And the reply was, if you never sell, you don't have to time the market.
Yeah.
So,
Right.
That's not a luxury that everybody has, though. I mean, that's
Well, no, it's not.
Right.
highly unusual.
But if you buy the right property that cash flows,
Right.
you don't have to sell as long as you understand what your cash flow is and getting in. And more importantly, you can still acquire properties now that perform cash flow wise, not even counting appreciation and therefore yields, that will perform as well as historical averages for the stock market. If you look at the historical averages, it's about 10% a year or so, roughly. But you can easily find properties that cash flow. On top of that, you have gain on equity and as well as depreciation benefits. So you have additional for tax benefits as well with real estate. So I mean, that's why I like real estate. There's so many different avenues where you can actually tighten up and go through it and weather the downtimes. In that as long as you're cash flowing and you have a strong corporate guarantee, you don't have to worry that the market's down and that you're going to lose the property. You can also use the leverage, and by leveraging it, there's no capital call like there is perhaps if you're doing within the stock market or so. I think ultimately it's probably less hands-on. I think if you're with the stock market, you can do extremely well. But you have to really watch it and understand that here's my portfolio, here's what I'm going to do with it, stick to that plan, don't react to the big swings and changes that happen, because ultimately they will self-correct.
Well, I do think
well.
the key thing you said there is to have a plan.
Yeah.
And stick to
either
your
way.
plan.
Either way, absolutely.
Exactly.
Any kind of investment.
And it's interesting because a lot of what you said, which I don't think you even realize, correlates very much with how you should be picking stocks.
Mm-hmm.
And
Absolutely.
maybe instead of income, you're getting dividend paying, and it makes you feel more comfortable, where you're still getting a payment each, quarter or whatever.
Absolutely.
And the difference, or so another similarity is when you're looking at these companies, you want to say, all right, can they make it through these changes?
Mm-hmm.
Will they adapt?
Absolutely.
Who is their marketing? How is their marketing? Where are they located? Are they growing? What stage are they in? All that's up. Same as if you're investing in corporate real estate. I would say the difference is a person that's investing in the stock market maybe doesn't want to be the person that's running the show, but they want to invest in somebody else running the show.
Right.
So if you're investing in corporate real estate, you have to be more hands-on. So people investing in the stock market, they don't necessarily have to be day traders or doing it themselves. They could say, you know what, I really like McDonald's, you know what, Microsoft. Look at the fundamentals, invest in it,
Right.
and then they don't even have to watch it at all.
Yeah.
They could just collect their dividends and, they could be off traveling the world,
Well,
like I did.
to some,
She always rubs that in.
absolutely.
It works.
And, I think that works, it can work. What I'd like about the real estate side of it, because I think the key word you said was adaptability. It's
Yeah.
not so much the largest or the strongest company that's going to survive, it's going to be the one that's most adaptable.
Absolutely.
And,
We saw that this
we
year.
saw that with Blockbuster, way back.
Oh, I have a story about that.
I'm sorry.
That was my worst investment.
It sounds
I
like somebody.
chose Blockbuster
Okay.
instead of Netflix
Oh, wow.
when they were both
Oopsie.
at
Wow.
when they were
Yeah.
both at $10.
But here's what I love about the real estate, is that the real estate that had Blockbuster in it you're still able to reposition it and bring in a different tenant and another
Yeah, you
person
can
into
re-tenant
it relatively well. So you have a very tangible, even if the company failed and you're left with, they're bankrupt, gone, nothing, you waited till the last minute, you're gone. But with the real estate side of it, yeah, they were having issues, but we all knew that ahead of time. And going into it, and you start looking to re-tenant it with another tenant that can come in, whether it was locally, there's the one down on Wilshire Boulevard, PetSmart went into it.
Yeah.
Or not PetSmart, but they're
Chase,
smaller.
and then the one.
And then Chase, and then, so,
Botensten,
you
yeah.
have potentially stronger companies that have come in, and then by re-tenanting it, repositioning the property, you're actually able to increase the income and the value of that property substantially. So it's an opportunity by having that real estate versus, the stocks where you might have just walked away with. Damn, I wish I had Netflix.
Yeah. So the funny, that is literally such a good example
Yeah.
of one of my key things when especially this year for looking at
Yeah.
companies is adaptability. I
Absolutely.
remember looking at the two of them and everybody was betting on Netflix. And I
Mhm.
sat there and I said, all Blockbuster needs to do is put their cassettes in the mail. That's all
Right.
they needed to do. They already had the consumers, they already had the storefront, they already had the marketing,
Mm-hmm.
and they could have competed.
Mhm.
And they didn't.
Yeah. They're too late to the game.
But it was just so,
Mhm.
it was such an obvious adjustment, this tiny adjustment
Mhm.
that could have saved them, in my eyes.
Or for that
And
matter,
so-
just buy Netflix.
Yeah,
I think they
could
made the
have
same
done that
mistake.
too.
Yeah, they
Well,
did
no,
that
they-
too.
They had that opportunity to purchase Netflix for
Yeah.
very low. very
Well,
little
even
money.
Netflix has succeeded because then they went into streaming.
Yeah,
And people are like,
absolutely.
"You're going into streaming, how does that work?"
Right.
Yeah.
And so,
So, yeah, no, I agree with you. So, if you're doing any kind of investing, whether it's stocks, real estate, or anything else, you're gonna want to really understand what the market looks like, where it's going, and then use the adaptability of it and try and figure out, well, has this company adapted historically? Because you have some great legacy brands out there that may be your tenants that are suffering, that are having a difficult time,
Yeah.
that you hear it all the time, that they've either gone out of business. A lot of them may have a issue where they have to declare bankruptcy and go down, but they reposition themselves if they're strong enough to do that.
so what
And-
happens during those months when you're in transition though? Like,
Yeah.
do you prepare for that? Because that's kind of like as
Absolutely.
if a stock is going down and you're getting hit and you're looking to
Absolutely.
fill another void and
Yep.
bring somebody in and,
Always looking to prepare for it. You're trying to figure out what you can do. I had, and what I mean by that is, like, let's say there's a property I'm looking at right now with a client. It is a corporate guaranteed fast food QSR in a smaller town. And my client was a little worried about it because there was only 2 years remaining on the lease with 2 5-year options. Potentially high risk. And when we start delving into it, I start looking at the demographics. The demographics of the area are about 30% higher as far as the income and population is decent, but the growth was average for the U.S. More importantly, though, when I looked at and delved down into the lease structure, the company itself, which 2-3 years ago I probably would not have recommended because they were in transition, having a difficult time, but they've really been able to reposition themselves really well. You're now looking at, it's a corporate-run guaranteed store. They just put $480,000 of their own money into remodeling that location 2 years ago, with only 2 years remaining on the lease. Their rent-to-sales ratios are only 5%, which is an extremely low number for fast food or QSR, and they're not going anywhere. And in fact, there's opportunity there to reposition that in multiple ways by either offering a little bit of money and cash up front for them to redo a new lease, maybe bring it up to a 7 or 8%, depending on what their debt looks like. You're going to look at the company and see what you can offer. A client and I are looking at a property right now that's kind of in a tertiary market. Everything is really good as far as the real estate fundamentals. The demographics are probably a little more average than great, but it's on a hard corner, signalized intersection, corporate client. They're concerned because there's only 2 years, less than 2 years remaining on the original lease term, which was originally 20 years. And I really don't believe they're going anywhere, because number one, it's a QSR that has really adapted and changed. A few years ago, I wouldn't have necessarily recommended this particular company, but I think they've done a really good job of rebranding themselves in the public image, and their sales have started to go back up. More importantly, 2 years ago, they did a full store remodel at their own cost, $480,000 they spent, which is almost a third of the total price of the real estate. It's basically building
So they
a
have to
brand
make
new
that back.
building.
Right.
And, they're not gonna make that kind of investment with if their plan was only to stay there for 2 more years. So they do have 2 5-year options. If anything, the best case scenario, because the rent is below market, is if they were to leave. You have a brand new building that you can re-tenant with somebody at a much higher rent. The other play is potentially that you could go into this property and just redo the lease, even keep everything the same. And by doing so, by having a new 15, 20-year lease with a corporate client, it's actually gonna compress the cap rate by about 100, 125 basis points. So you immediately create equity by doing so. And this is something that they're gonna be open to, even if you don't increase the rent. It's a great little opportunity. So I think you can find real estate just about in any market that is good to purchase, just like you could probably find stocks in any type of, any type of
Yeah.
industry
And
that may be good.
And you're right, because investing in corporate real estate does depend on the economy, which is the stock market.
Yeah.
And in return, the stock market is also based on what's happening in these like small towns as much as it is in the bigger cities and all around the world. So there is a lot of correlation between the two and the movements.
Absolutely. I think you're right on in that a lot of what we do in the real estate side, I think what you're saying is the same that you do on the stock market side, is actually, it's not just looking at the real estate, but looking at the companies who your tenants are. A big thing this last year has been COVID-resistant tenants, or tenants that are essential retailers have been considered that.
Like medical, fast food,
retailers like dollar stores that are still doing very well. And then and supermarkets. But more importantly, what we're looking at as well is, a COVID-resistant tenant, this is really a kind of a once-in-a-lifetime happening.
We hope.
Everything, we hope, that has happened. Historically speaking, it's a once-in-a-lifetime thing.
Yeah, we didn't think it would get worse than 2008. And
No,
when
we
COVID
didn't.
happened, I was
We
like,
didn't.
okay.
Well, I meant like a pandemic of this nature and this size. And, so instead, we're also looking at the economic or tenants that are resistant to down economies.
Yeah.
Whether it's fast food, whether it's dialysis companies, pharmacies. These are things that no matter what, people are going to need and use and actually do well in down economies. So we look at that as well.
You're hedging it based on who
Absolutely.
the tenants are.
Looking who the tenants are, how you can reposition it. I think the biggest thing that we do here as far as with brokers, and I think the biggest value that we add, is not so much finding the right property and the right tenant, it's understanding the exit strategy, whether it's 5 years, 10 years, 20 years down the road. Meaning every single property I look at and recommend to a client, I'm thinking worst case scenario, what happens if this tenant goes out of business? What am I going to do with that real estate?
Well, a good investor is looking way down the road.
Absolutely.
Even if they're going to own it shorter term, because the what ifs are huge. I mean, it could be, you don't know about COVID right now. It could spike again March, April, and here we are again. So you really got to be taking a look. Now, I'm going to throw you guys under the bus a little bit. Ideally, in my portfolio, how would I want my real estate versus my stocks? What do you say?
Well, so when it
Or
comes
stocks versus real estate?
Okay, so this a little bit ties in with what you were talking about with looking at tenants, is that you always want to diversify.
Right.
So you always want to make sure that you have a balance of high income, consumer cyclicals, a little bit more risky. So it depends on your age, how much money you have, et cetera, et cetera. Real estate is a very good income stream. And you can invest in real estate without actually buying the physical property. So you can go into REITs, there are ETFs, there are properties, like Simon properties that you can invest in. There are many ways to invest in real estate if you don't have access to you guys or the income. And so I would say, yet again, it fluctuates with the market, but normally I wouldn't go above 10% in real estate in your portfolio. Now, that's not including what you own on
individually.
the side, right?
Yeah.
So if you decide that you physically want to go into corporate real estate and buy buildings, then I would say that goes down a little bit more. But for somebody that owns a house but still wants access to real estate, then I would say 5 to 10% is
Well,
is
also,
the
you know,
number.
we tell a lot of newer investors that you should really look at investing in a real estate investment trust or something along that line, so you can start getting the documents and see what they're looking at. It's really good, you know, it doesn't take a lot of money to learn there.
Yep.
And so you can go in, learn, hopefully your stock goes up, but it's just a great way to get started. So, so did you answer me yet? You said 10% on the portfolio.
Well, she answered.
Yeah, and I also said, I said no more than 10%. Ideally, I'd say 5, but it's not discrediting the fact that I think real estate is a very, very good investment.
Yeah.
But when it comes across, you know, diversifying, it seems like a small portion, but I do think you do need real estate.
Yeah.
And ideally, the American dream is to actually go out and buy something for yourself.
Sure.
So if you get to that point and you can do that, then you don't necessarily need as much in your stock portfolio. But until then, there are ways.
I agree, because I mean, I think when you're starting off, the barriers to entry into the stock market are much lower than the barriers to
Absolutely,
entry
yeah.
going into real estate investment.
Start off with a
You
few
know,
$100s instead of a few
you-
$100,000.
A few hundred or $1,000, you can easily start off and
Yeah.
create that and start creating, well, there's even some new apps that will start your investing by rounding up your purchases, running through them. You know,
Right.
so
Yeah.
you're literally doing it pennies and pennies going into funds and growing it that way. I'm the exact opposite. I actually think you should, you know, I keep as little as possible because I always have felt that in the stock market, there are so many variables that you have no control
Right.
over. Whether, you know, because it tends to be a little bit more of a knee-jerk reaction with what's happening, and you're almost betting with people. You know, and there's an old saying, never bet on something where people are involved.
Right.
So I look at it as I'd rather instead something a little more tangible that I have a little bit more control over. I get to pick my tenants. I get to
So
pick
90-10, is that?
90-10, the other way
Yeah, I
around.
thought so.
So and I think it all depends.
Yeah.
It depends on your personality.
Yeah.
And really, actually, you know, 90-10 is probably a little bit
And how much cash?
unrealistic.
How much cash
Yeah,
is in
well,
there?
that's true.
And yeah, so
Yeah, she'd always have cash left.
I would always, but you know, the percentage in real estate is going to be a lot higher for
For
me.
you.
And I think that really depends on the person. You know, if you look at the net worth of most people, the majority of that is in their real estate holdings. A lot of that may be a house, and that may not be an investment.
Right.
But the majority of most people's net worth that own real estate is in the real estate. You know, and you know, the last thing I'm going to leave everybody with is the last 200 years. You know, I like history. I'm a history buff. Over the last 200 years, 90% of all the millionaires made their money through real estate. They became millionaires through real estate.
Yeah.
So, you
Now,
know,
what percentage of those started with real estate?
well,
So,
Very
yes,
few,
yes, I
probably.
agree, you can make a lot of money, but
very few.
you have to start with
No.
the basics, and
Yeah.
so I think you build up your income, you
I agree.
put it in the stock market,
Yeah.
you learn, and then you get
Yeah.
to that point where you could have multiple properties kind of just driving income for you.
absolutely.
And I think that's wonderful, and I agree, I just think they have to start
Yeah.
at the
You know,
beginning,
and
in the market, you know.
It's funny you say that because a lot of my clients are actually a little bit older as well that are kind of going out and getting rid of their portfolios, whether
Yeah.
it's in stocks or bonds or
Yeah.
and whatnot, because they're feeling that there's too much volatility in it, and they
Yeah.
want something that's a little bit more stable, that they know this is what I'm going to get. They're cutting coupons essentially, which I think actually,
And I agree with
the bond market for the first time ever earlier this year, it was outperforming anything else.
Right.
For the first 6 months of this year, and obviously changed since, and that's a unique thing. That was people looking for kind of safe harbors, looking for that coupon clipping, looking for
Yeah.
something that they can count on. I see that more and more with some of the older people looking toward their retirement, looking to look for passive income, which is a great way for real estate to do that, while at the same time getting tax benefits and potential appreciation if it's done right. So, yeah.
And I would recommend the same. There's, the first thing you ask investors is, one, how old are you? And to be very honest, it makes a big difference on how you diversify their portfolio. If you're in your 20s and
You can
you're
afford to
starting
lose.
out,
Yeah.
I'm going to put you in some more risky stuff because I know you can ride out the wave.
Yeah.
The wave, when you're at 20, you're going to see a few waves until you're in retirement. If you're in retirement, you need to be conservative, you need income,
Yeah.
you need to be getting away from the more risky side. And so I think it's very smart to go into corporate real estate as you get older because you're right, it's the
Guaranteed
revenue stream there.
leases, yeah.
Yeah.
Okay. All right, well, that was very interesting. We probably went a little long today, but, all right, well, thank you for tuning in. Kerry, why don't you, I guess we need to talk about your website that you launched.
Yeah, so we were launching this year, and it's a travel company, and what it does is it matches up hosts with travelers, and the whole idea is to have smaller group trips. And on the group trips, you're traveling together with like-minded people, but you're also traveling under the expectation of knowing the host. So when you go onto the website, you set up your own profile, you communicate with people before you travel, you see your host, you see how they travel, they do their local spots, they go off the beaten path. So we're trying to get away from the big bus, the mainstream way of traveling without traveling by yourself.
Okay,
So
that's very
it's a
interesting.
way of connecting people and taking away, kind of like in the stock market,
Yeah.
it goes back to the stock market, taking away the fear
Right.
of arriving somewhere and not knowing who you're with or what you're doing or who you're traveling with. So if we can get that done before you get on a plane or before you get in a car or a train,
Makes it a lot more comfortable.
then you get there and you already feel comfortable
Yeah.
and safe.
Very cool. What's the name of the website?
Tripsha.
Tripsha. TRIPSHA.com.
And we'll be, obviously this year, we had to put everything on hold,
Oh, yeah.
but next year, we'll be up and running again. I'll be putting most of the updates on my
Mm-hmm.
Instagram. And then once we start launching some trips,
There you go. And all the money you've made from either the stock market or real estate, you can go on vacation and meet
Yeah,
Kerry.
yeah.
I will put Kerry's link down below. So, but if you want to talk to George or to Kerry, you can DM me directly or their links will be down below. So thank you for tuning in and we'll see you again next week.